Hello, this month I'm going to concentrate on the key differences between the UK and US stock markets and what that means for their likely future returns. Uh, in my view, this decision is one of the key decisions all investors will have to make in the next few years, and I think it's going to make a very big difference to returns. So, generally speaking, what investors tend to do is make a judgment about any investment based on how well it has performed recently. So, in this case, the US stock market has performed phenomenally well versus the UK. In the last 5 years, 122% increase in the US versus only 36 in the UK, so almost four times the growth. And unsurprisingly, people are very positive about US investments and have all sorts of reasons and justify why this trend is likely to continue. Now, I don't believe that's the case, and I'm going to try and make the argument for that today. So, the first thing that people focus on is the constituents of the US stock market. So, the US stock market, if you include Tesla as a technology company, has over 30% of its index in technology. And not only is it in technology, which people think is a high growth area, but the companies that represent that technology weighting are extremely high quality, industry dominating businesses like Apple, Google, Facebook, Tesla. And this leads people to think that growth from the US stock market is going to be structurally much higher, and therefore it's well worth paying a much higher price for US shares than other stock markets. Now, I don't believe that's true, and the main reason I don't think it's true is because we're being asked to pay such a high price for US shares today that the growth that you have to get to justify that is unlikely. I think. I mean, in fact, I think the US market is in something of a bubble. So, if you looked over the last 10 years and averaged the earnings from the US market, today's price is about 40 times that average. And in the UK, as a comparison, it's about 13 and a half. So, three times the multiple of profit. Now, if you looked at some examples and understood what would be required to justify it, you can start to see how unlikely it is. So let's look at Apple, which is a fabulous company. Many of you will be watching this on Apple phones and will enjoy using it, and I have no intention of not using it. However, Apple is very mature in terms of market share. So in the markets it's allowed to operate in, because it's really excluded to a certain extent to operate in China, it has a very high market share of the people who have the budget to be able to afford the £40 to £45 a month it takes to own an iPhone. Now, but despite that, you're expected as a shareholder to pay about 40 times next year's profits to buy Apple. Now, not only has Apple had a great COVID period as people rushed to upgrade their phones to entertain themselves when they were at home, but actually in order to justify a 40 times price earnings ratio, well, you really need to expect the profit for Apple to grow by 3 to 4 times before it reaches profit maturity and sort of stability or maybe sort of gradual decline. So if you think about the amount of income that Apple is taking out from its saturated market share today from people that use it, how much higher do we really think they can move that? Do we think they can take £180 a month out of everybody that uses an Apple on a foreseeable basis? I don't think so. I mean, it's possible, but I think it's unlikely. And I also think that people are ignoring completely the very trend that made Apple the great company it is, which is technological change. People assume that it will never come under attack, and so I think the risk reward for buying Apple shares today is quite poor. I could make similar arguments, although I don't have time, for Facebook and Google, and certainly Tesla, which I think is a very dangerous investment at this point. Now, if you compare that to the UK is a market which generally people don't like. And they don't like it for two reasons. One is people are convinced that the UK is in some kind of long-term structural decline. And also people think the companies that are listed in the UK aren't going to do very well in the next 10 to 15 years. Now, I think both of those assumptions are also incorrect. So the structural decline argument is really a hangover from the whole Brexit debacle that we've seen within the country over the last few years. So Brexit, in my view, is predominantly a political decision. Whether you think the costs are worth the benefits is about what kind of life you want to lead, and and there are different winners and losers from that. and I'm certainly not going to get into that today. However, to believe that it's primarily an economic issue, I think is very misguided. So you're really trading off the relatively small part of the UK economy, about 6% I believe, which is dominated by exports to the EU, against the rest of the UK economy, which is affected by regulations. So the benefit of Brexit economically is we have the ability to create more nimble, more innovation-focused regulations in this country, and there is undoubtedly great scope to improve our economic performance from doing that. So any argument which frames Brexit as structurally leading to lower long-term growth, I think is flawed. The other side of the reason people don't like the UK is because of the constituents. And really what they mean by that is the UK is has quite large weights in companies which are exposed to old industries like oil and gas, commodities, and consumer durables, consumer discretionary companies like Unilever. Now, people think these companies are either mature or they're in industries which are likely to die or run out of steam in the next few years. Now, I think those arguments are significantly overdone. And if we look at commodities and oil and gas, which is a large part of the UK, the FTSE, actually we've seen 5 to 10 years of very low investment in new capacity, especially in the oil and gas sector, but also in other areas like copper. And I think we're very likely to see 5, 10 or 15 years of high prices and very high profit growth. So don't be fooled by the last 10 years and assume the next 10 years will look the same. And certainly don't take the last 10 years as a justification for paying 3 times the profit that you would be expected to pay in the UK. So that is our view on the outlook. I mean, I regularly see funds which have 50% of their stock market exposure or more in the US, and I would just want to counsel all of you to be very wary of that and to be aware of the unwinding of what I think is a bubble over there. Now, I have 2 further things to say. Lastly, the last thing, 2 things, is I'm going to encourage you to subscribe to Flying Colours YouTube channel. And if you do like it, please do, because you'll automatically receive our updates. And of course, the very last thing is I need to remind you that I am talking about investments, and whenever you talk about them, you have to consider your capital to be at risk. Thank you.